talking about SBI, we have with us Ashwini Kumar Tewari joining in on the show right now. Mr. Tewari, good to have you on the show. Good morning. Let's first talk about the rate hike. What is it truly telling us about this rate hike? That of course, it was surprising and a big one, the quantum that is 40 bips, done during market hours. This is coming just a month after RBI was fully comfortable about the situation, including inflation. What do you think has changed dramatically since then to now?
Good morning. I think RBI did make it clear that even in the last meeting that they will be driven by data which is coming, and the situation is extremely volatile because of the war in Ukraine, and therefore the resultant hikes in the oil price and also the commodity prices and edible oil, all of which are important variants, important ingredients into the India's inflation number. And inflation has been above the benchmark for last month and likely to be so this month. So maybe some early data which RBI has got has led them to take this decision even within the two meetings. But as the governor explained, they have done this last time also to respond to the COVID pandemic, and they reduced by 115. So therefore, 40 basis points to react to whatever developments there are which are happening is okay. And the other thing we have to remember is the Fed rate hike was imminent, and it has actually happened last night. So therefore, to maybe make sure that not too much outflow happens from other markets, even as equity market FI outflow has been happening for some time. But other markets, debt markets, bond markets, all of those, maybe some outflow could be held because of the Fed action. So those two could be the reasons, I think.
Tewari, let's also talk about the problem, because there is a theory that the inflation in the country is currently largely supply driven and linked closely to crude. This could compress demand. So do you think the RBI should have hiked rates earlier in the first place?
So you rightly say about the demand part. I mean, as per the last estimates of March numbers, the consumer demand, which was either flat compared to the pre-COVID period or just below that number. So therefore, RBI has been supporting the demand and the growth by not hiking rates. So hiking it earlier probably would not have been okay for the demand because the recovery was still fragile. Recovery has been improving all this while, but RBI's mandate is inflation control. So it has to be a balance between inflation control and growth. And the governor did talk about in the last meeting also that in case it is warranted, then inflation has to be given priority, and which he has done now. So therefore, I don't think there is any reason for him to have hiked earlier, because then the growth then could have been impacted. And now, of course, since the inflation continues to be high, it is hurting people, and it is percolating into all the different cost segments. It is not only crude driven, it is commodity driven, it is edible oil driven, so many other inputs which are linking to CPI and WPI both.
Mm-hmm. Okay, and give an overview as to what is going to happen now in terms of loan rates going up, EMIs as well rising with immediate effect. What do you think is going to be the impact of this on retail consumers, and any sort of an impact as well going forward on corporate and retail loans going forward?
Four broad things which are likely to happen. On one side, as you rightly say, retail loans for most banks, including us, are linked to the repo now as the external benchmark. So while we haven't taken a call now, and our asset liability committee will meet shortly to take a call, but we have seen some banks already hiking these rates. So it's a natural thing that the pass-through will happen. So those rates will go up, and therefore the EMIs will also go up. As far as other corporates are concerned, corporates have been deleveraging for the last 2 years. So large corporates, I don't think there's too much impact. In any case, the interest costs were about 8 to 10% for most corporates, even lower for those who have deleveraged faster. So for them, it won't make too much of a difference. Of course, some interest high, some impact will be there because the market bond rates, etc., also will go up. But overall, the corporates, I don't think will have too much of an impact. It is the MSME sector which typically is a larger borrower of about 15 to 20% of their cost is interest cost typically. So there may be some impact to MSMEs, but overall the rates for MSMEs are anyways quite low. And especially when they are supported by CGTSME and similar schemes, I don't think it is going to be a make or break situation for them, because for them the more important thing is liquidity and timely availability of credit. So as long as we focus on making credit available to them, they should be able to absorb this cost. No doubt, it's a hike from where they were from presently. But I think since the system as a whole is moving, this should happen. And finally, the risk pricing. I think we have been talking about from SBI and others as well, that the risk pricing was not very proper earlier. There were loan rates which were given, which is lower than the sovereign rate, which is not a good idea. So therefore, some risk correction and pricing based on the risk will happen now, which is a good thing for the system overall. So that is the overall sense I get from this policy about various rates.
Mr. Tewari also wanted to understand, if you could really help break down the impact of this on bank margins as well as profitability. The repo increases margins and the CRR rebalances that. Tell us, what does it mean for SBI in particular, and how do your workings then change?
Yeah, so if, as I said earlier, that our ALCO still has to take a call on this. So assuming that the rate hike passes through that 40 basis points, because that's clearly directly linked to the repo rate. So that portion of rates will increase. On the other side, the MCLR, we had done some small hike of 10 basis points earlier. We'll have to do a reworking on that to see what is the impact. Overall, I think the impact of CRR hike, which takes away some liquidity and therefore some availability of credit for us, is very minimal, just about 2 basis points for us. So that's not too large. At the same time, how much hike, if any, we'll do in MCLR is something we still have to work out. So therefore, on balance, I would say that the impact on margins is not likely to be significant. In fact, margins may see some improvement because of this direct link hike, which is going to happen. On deposit side, we've been raising rates, and I think over time, for most of the maturities, we will look to raise rates. So net, I think the impact on margins for us is not likely to be too significant.
Right. Thanks very much for joining in and giving us an overview as to what this means from the retail consumer as well as from the bank's perspective. RBI's move to go ahead and hike interest rates. That's a surprise move indeed.